Have you been told that FHA loans are for first-time buyers and conventional loans are always better? Or maybe somebody told you that FHA is the only option if your credit isn't perfect. The truth is, neither of these statements is completely accurate. I talk to buyers every week and they ask me the same question. Chet, should I go FHA or should I go conventional? And the answer is almost never as simple as people think. In today's video, I'm going to break down the biggest differences between FHA and conventional financing, including credit score requirements, down payment requirements, debt to income ratios, mortgage insurance, monthly payments, and why the loan with a lower interest rate isn't always a cheaper loan. And by the end of this video, you'll have a much better idea of which option may make the most sense for your situation. So let's jump in. Before we get into the details, let's clear up one major misconception. A lot of buyers assume conventional loans are automatically better than FHA loans, and that's not true. And on the flip side, some buyers assume that FHA is only for people with bad credit. That's not true either. I've had clients with excellent credit use FHA because it gave them a better overall payment. I've also had clients choose conventional loans because it saved them money over the long term. Here's the deal. The best loan isn't determined by the name of the program. It's determined by the numbers. So let's start with credit scores. This is usually where the conversation begins. Conventional loans generally require a minimum credit score of 620. FHA loans, much more flexible and can allow much lower scores depending on the situation. Now, just because a program technically allows a lower credit score doesn't automatically mean you'll qualify. Lenders still look at your income, your debts, your employment history, and the overall strength of your application. But FHA definitely gives buyers more flexibility when credit isn't perfect. And that's one of the biggest reasons many first-time buyers end up choosing FHA. So next, let's talk about down payments. One of the biggest myths in real estate is that you need 20% down to buy a house. You don't. In fact, most buyers don't put 20% down. Conventional loans can allow as little as 3% down in certain situations. FHA loans generally require 3.5% down payment. So from a down payment perspective, they're actually pretty close. The important thing to understand is that your credit score often influences which option makes the most sense. So for some buyers, conventional works great with a smaller down payment. For others, FHA provides a much easier path to approval. So with that, let's talk about one of the most overlooked parts of mortgage qualification. That's your debt to income ratio. This is simply a comparison of your monthly income, your gross monthly income, versus your monthly debt obligations. Things like your car payment, student loan payments, credit card payments, personal loan payments, and your future mortgage payment also needs to be included. All get factored into the equation. Why does that matter? Because FHA is generally more forgiving. If you have more monthly debt than average, FHA may allow you to qualify when a conventional loan won't. This is a huge reason why some buyers are approved with FHA but struggle with conventional financing. It's not always about credit score. Sometimes it's about how much debt you're carrying relative to your income. So let's talk about the thing now that everybody hates, mortgage insurance. And every time I bring up mortgage insurance, buyers immediately assume it's a bad thing. But honestly, mortgage insurance gets a bad reputation, and here's why. People focus on the existence of mortgage insurance instead of the overall payment. Let's say loan option A has mortgage insurance and loan option B doesn't. Most people automatically want option B. But what if option A still gives you a lower monthly payment? What if it helps you buy sooner? What if it allows you to keep more cash in the bank? Those things matter too. The goal isn't to eliminate mortgage insurance at all costs. The goal is to make the smartest financial decision. So now there's an important difference. With conventional financing, mortgage insurance can eventually go away once you reach the required amount of equity. With FHA, mortgage insurance works much differently. Depending on your down payment and loan structure, it can remain on the loan much longer. That's why it's important to look at both the short-term and the long-term impact when you're comparing options. Again, this is where running both scenarios side by side becomes incredibly valuable. So here's something that also surprises a lot of buyers. The loan with the lower interest rate isn't always the better loan. I will say it again, the loan with the lower interest rate isn't always the better loan because there are other costs involved. Mortgage insurance, loan structure, upfront fees, monthly obligations. What really matters is your total payment and your overall borrowing cost. And I've seen buyers choose a loan because they like the interest rate they saw online, only to discover another program actually gave them a lower monthly payment. So don't focus on one number, focus on that entire picture. So let's look at a simple example. Imagine two buyers purchasing the exact same home. Buyer number one has excellent credit. Buyer number two has decent credit, but not perfect credit. The buyer with stronger credit may find that conventional financing offers very competitive pricing and lower mortgage insurance costs. The buyer with the lower credit score may discover that FHA actually provides a significantly lower monthly payment. Same house, same purchase price, completely different results. That's why this blanket advice on the internet can be really dangerous. The best loan for someone else may not be the best loan for you. So, who should consider FHA? It might be worth considering an FHA loan if your credit score isn't perfect, if you have higher debt to income ratios, if you're trying to maximize your buying power, if you need a more flexible approval process, you're a first-time buyer looking for options. Again, FHA isn't always better, it's just designed differently. And so who should consider a conventional loan? Conventional financing might make sense if you have strong credit, you have the ability to make a larger down payment, you want mortgage insurance to eventually fall off, you qualify for competitive conventional pricing, and you want more flexibility with certain property types. So for many buyers with strong financial profiles, conventional financing ends up being a really great fit. So which loan is better, FHA or conventional? The answer is neither. The better loan is the one that helps you achieve your goals while keeping your payment affordable. So every buyer is different, every credit profile is different, and every financial situation is different. That's why the smartest thing you can do is compare both options side by side before making a decision. So if you're thinking about buying a home and you want to know which loan makes the most sense for your specific situation, reach out to me. I'd be happy to run the numbers and help you see exactly what your options look like. And if you found this video helpful, make sure you share it with someone who's planning to buy a home. We are glad to help.